Hey everyone, my name is Alex Morgan, and welcome back to the channel. Today we need to have a serious conversation about silver, because the next 7 days may mark a decisive turning point for the entire precious metals market. This is not a routine weekly update. This is a structural warning. Silver is sitting at a compression zone where technical pressure, macro catalysts, bond market dynamics, and investor positioning are converging at the same time. When multiple forces align in a compressed window, markets don't drift. They reprice. Right now, silver is trading within a narrowing range after experiencing recent volatility driven by U.S. inflation data, Treasury yield fluctuations, and dollar strength. The market is not trending strongly up or down. Instead, it's coiling. And when silver coils, history shows the next move is often aggressive. Let's begin with the macro core, real yields. Silver, like gold, is highly sensitive to real interest rates. When inflation-adjusted Treasury yields rise, non-yielding assets like silver face pressure because investors can earn safer returns elsewhere. But when real yields decline, silver becomes more attractive as both an inflation hedge and a store of value. Over the past several months, real yields have oscillated. At times, strong employment data has pushed yields higher, signaling economic resilience and delaying expectations for rate cuts. At other times, softer manufacturing and consumer data have eased those pressures. The next 7 days include critical inflation releases and Federal Reserve commentary that could shift expectations rapidly. If inflation data comes in softer than projected, bond markets may begin pricing earlier rate cuts. That would likely weaken the US dollar and compress real yields, both historically bullish for silver. However, if inflation surprises to the upside, yields could spike sharply. A spike in real yields is one of the fastest ways to pressure silver lower in the short term. Now, let's examine positioning. Futures positioning has normalized compared to previous peaks. Speculative long positions are not stretched, meaning there is room for new long positioning if a bullish catalyst appears. At the same time, short positioning is not extreme either. This creates a balanced but unstable structure, the kind that can tip quickly in either direction. Options markets are also showing rising implied volatility expectations for near-term expirations. That signals traders anticipate movement. They just don't know the direction yet. ETF flows are another important signal. Silver ETF holdings have stabilized rather than declining sharply. This is critical. Structural bear markets are often accompanied by heavy ETF liquidation. We are not seeing that. Instead, investors appear cautious but not abandoning the metal. This tells us the current pause is not panic-driven. It's data-driven. Technically, silver is compressing near a key resistance support cluster that has acted as both a ceiling and floor in recent months. Markets rarely remain compressed around such zones for long, especially when macro catalysts are imminent. So why exactly are the next 7 days so important? Because we are at the intersection of monetary policy expectations, inflation trajectory, industrial demand trends, and currency movement. Let's talk about inflation. If inflation continues moderating gradually, the Federal Reserve may begin signaling flexibility. Even a subtle change in tone can shift capital flows. Silver tends to react early when rate expectations shift. Markets don't wait for rate cuts. They price anticipation. If inflation proves sticky and wage growth remains strong, policymakers may maintain restrictive stances longer. That could temporarily cap silver's upside. But here's where it gets deeper. Fiscal deficits remain historically elevated. Global debt levels are at record highs. Governments cannot tolerate prolonged high real yields indefinitely without fiscal stress. Over time, that dynamic creates pressure for accommodative policy. Silver thrives in environments where monetary flexibility increases. Now let's layer in industrial demand. Approximately half of global silver demand is industrial. Solar panel manufacturing remains a structural driver. Global renewable installations continue rising, even if silver intensity per panel declines modestly. Total installation growth offsets efficiency gains. Electric vehicles require significant conductive materials. Semiconductor manufacturing expansion for AI and data centers also supports silver demand. Electrification trends are not cyclical headlines. They are multi-decade structural themes. Mine supply, however, is constrained. Silver is often produced as a byproduct of base metals like copper and zinc. That means silver output depends on base metal production cycles. If copper production slows due to economic weakness, silver supply may tighten even if silver prices rise. Environmental regulations, declining ore grades, and geopolitical mining risks further limit rapid supply expansion. Now let's consider the gold to silver ratio. When silver begins outperforming gold, it often signals rising risk appetite within the precious metals complex. Recently, the ratio has fluctuated without clear direction. The next move in this ratio may confirm whether silver is preparing for leadership or lagging again. Currency dynamics also matter. The US dollar index has shown strength during periods of economic outperformance, but if inflation cools and rate expectations soften, the dollar could weaken. A weaker dollar mechanically supports dollar-denominated commodities like silver. Now let's outline forward scenarios in detail. Scenario 1. Bullish expansion. Inflation prints softer, real yields decline, the dollar weakens. Silver breaks above its recent resistance zone with volume confirmation. Momentum funds and algorithmic systems amplify the breakout. ETF inflows accelerate modestly. In this case, silver could move quickly toward the next major resistance band. Scenario 2. Shakeout before rally. Inflation initially surprises higher, yields spike, and silver dips below support briefly. Weak hands exit. Then macro data stabilizes and yields cool again. Silver reclaims support and begins a more sustainable rally. Historically, silver often experiences false breakdowns before major upward expansions. Scenario 3. Sustained downside pressure. If inflation reaccelerates significantly and central banks reassert hawkish tone aggressively, real yields could rise sharply. In that case, silver could retest deeper support levels. However, unless ETF liquidation accelerates dramatically, this would likely remain corrective rather than structural. Probability analysis suggests we are more likely to see volatility expansion than stagnation. Silver's historical volatility profile shows that extended compression periods are followed by directional breaks. The longer the compression, the stronger the eventual move. The warning here is not that a crash is imminent, nor that a guaranteed rally is forming, but that indecision is about to end. Now let's look at investor psychology. Sentiment is cautious but not euphoric. Retail enthusiasm has cooled from prior peaks. Institutional positioning is balanced. This is often where markets build energy. When nobody is fully convinced, breakouts carry more power because fewer participants are already positioned. Another key indicator to monitor is mining equity performance relative to silver price. If silver miners begin outperforming the metal itself, it often signals forward-looking confidence in higher prices. The next 7 days will provide clarity. Watch CPI, watch PPI, watch Fed commentary, watch the 10-year real yield, watch the dollar index, watch ETF weekly flow reports. If these indicators align in favor of easing expectations, silver could begin a new upward phase that extends into the coming quarters. If they align toward tightening persistence, silver may require additional consolidation before regaining upward momentum. But either way, neutrality is unlikely to persist. Markets do not stay compressed around macro inflection points. Silver is not drifting. It is waiting. Waiting for confirmation. Waiting for repricing. And when silver reprices, it tends to move faster than most investors anticipate. Over the medium term, structural supply constraints, electrification demand, fiscal pressures, and potential monetary flexibility all create a constructive backdrop. Short term, however, the next 7 days are pivotal. This is the kind of window where risk management matters most. If you found this extended deep dive helpful and want continued advanced analysis on silver, gold, and macro capital flows, make sure you hit the subscribe button and turn on notifications so you don't miss the next update. Drop your view in the comments. Do you think silver breaks higher this week, or do we see one more shakeout first? Thanks for watching. I'll see you in the next video.